So, Jonathan, in video number one today, we talked about Silicon Valley Bank. We obviously also had Signature Bank in your neck of the woods. I find it odd. One's in my backyard, one's in your backyard. We have First Republic, at least seeming to be on life support. We had Credit Suisse over in Europe. I just got to ask, are we on the cusp or in the midst of a banking crisis?
So I don't think so.
Okay.
Yeah.
Tell me more.
There are a number of reasons why I don't think so. So the first reason I think is like systemic, right? After the great financial crisis, sort of rare for, I think what usually happens, there were actually reforms instituted that required banks to have higher reserves and basically be in better financial shape and be able to withstand a crisis and not be on the verge of collapse. And the banks instituted those reforms, and I think the banks are just on a better footing than they were going into the great financial crisis. The other thing I think systemically that is good is that in the great financial crisis, like every bank in the world was exposed to these toxic assets, right? They had all bought into the idea that
real estate only goes up. Yeah.
That real estate only goes up, that mortgage banks, that these mortgage-backed securities, which were, these groups of mortgages that couldn't possibly all fail, they were not correlated with each other, that they were bulletproof, right? And they all bought into this story.
AAA.
Right. And so they were all exposed to this, right? Yeah. And once the dominoes started to fall, like they all just fell. And this time around, lending has been much tighter, the standards have been tighter, and we just are not in the same situation.
Yeah. So let me push back just because I can.
Yeah.
I'm just trying to steel man the other side. So you're right. The last crisis, it was about mortgage-backed securities. And frankly, and what is similar is that was a toxic asset that wasn't marked to market. And it was only once it was marked to market that you saw who was swimming naked.
Right.
I find it pretty interesting. And again, Bank of America, somebody just did a deep dive on Bank of America I read it this morning, talking about Bank of America having something like $160 billion in unrealized gains. FDIC last week came out and said the entire banking system has, I think it was $680 billion in unrealized gains. Again, this is very much mark to market versus hold to maturity. I do find it odd that a lot of that is in now treasuries, right? People went out and like Silicon Valley Bank, they borrowed they lent short and borrowed long, or it's just crazy. And now that's what really ate them alive, caused the bank run. And $42 billion in a day, that's $500K a second. That's just wild to think about. And we do have this. We have banks with unrealized losses. What do you think of that?
Well, yeah, I mean, they're definitely all exposed to this, right?
Yep,
for sure. But I think the issue with Silicon Valley Bank, and I think Signature Bank too, was like the lack of diversification for both of them.
Yeah, they didn't protect the interest rate risk for sure. Yeah.
Right. Well, there was that. And then there was also the fact that they were heavily exposed to like one asset class each.
Yeah, so concentration.
So Silicon Valley is just all about like tech startups, right?
Tech and biotech. Yep.
Right. So they had kind of like a unique situation. Plus, it's now emerging that they had some serious operational problems here as well, right? So they had no chief risk officer for 8 months.
Right? I saw that. It's like TBH. He or she's not doing much. TBH. So
I think there are some unique circumstances at SVB. Obviously, right, it's exposed that it was carrying more risk on its books than it should have been. But it also has, I think, the situation is not like broadly replicable across the entire banking system, right?
Well, sort of yes and no. So again, I want to push back on this just because we can. I think these unrealized losses, it would have been a disaster. The banks would be down even more, and I'm even talking the big banks this week, if in Sunday's announcement, early evening for me, late evening for you, they didn't do what they did at the discount window. I think the thing that saved this week, and again, it's not been a particularly great week, but it would have been worse, is how banks now can take a unrealized bond that's worth 72 cents. They go to the discount window and they get $1. That is a subtle saving grace.
Yeah.
Because now those unrealized losses, for all intents and purposes, are gone. they vanish. And I don't think enough people realize that was really the magic sauce. Everybody's talking about the bailout of depositors. That was cool. That was meant to send confidence. I don't think the average depositor understands any of that gobbledygook. So it didn't work because near as I can tell, Bank of America got $45 billion in 2 business days. So it's clearly not working. But for people that do deep dives on balance sheets, that ability to take a 72% bond to the Treasury or the Fed or whoever it is, I guess it's the Fed, and get $1 back, that saved banking. It would have been a crisis if that didn't happen, in my opinion.
I mean, fair point. I don't know what to say about that. I think it's just, you're right.
I think that was that was the most important thing on Sunday that was missed by 99% of people. Was that that ability to magically erase 28% of loss?
Yeah,
nobody caught that.
I mean, yeah, well, that's obviously vitally important. I mean, I think the fact that they did go and immediately step in and provide liquidity and stuff made a huge difference. And also, I mean, what we saw in the Great Financial Crisis, which we have not seen here, is, in 2008, the Treasury made a really just a horrible mistake, which was letting Lehman Brothers fail. Right? They had this idea that, well, the shareholders need to bear they were like, this is moral hazard. We can't encourage people to be making risky bets. And so we have to let this fail to send a message to the market. But the problem was that the message that got sent to the market was, holy shit,
every bank could fail.
The world is going to fall apart. Right. Yeah. And so that was in retrospect, a really bad mistake. And had they not done that, I think things would have played out quite differently, right? I mean, they could have, come in and said, look, the executive, which is what they did this time, right? All the executives who are responsible for this, you're collecting unemployment next week, right?
Yeah, you're fired. Your options are worthless. No golden handcuffs.
That's right. Done. You're out of here. You got to, and that would send a pretty chilling message. And I think and the shareholders obviously are
equity to zero. I love that.
Yeah. The shareholders are bearing the brunt of it in the collapse of the stock prices, right? But it didn't send a shockwave through, the administration didn't say, oh, you know what, Silicon Valley Bank deserves to be punished for what it did, so we're going to let it collapse. They learned their lesson from the last time around, fortunately.
They created an organized and created guardrails. But yeah, I'm really pleased equity was wiped out. Execs are out. They're probably going to do clawbacks. It would not shock me. Because again, it looks like these people sold a lot of stuff in the last month. I fully expect clawbacks. I actually expect somebody to go to jail.
I think so.
I think somebody's going to jail.
And I think obviously not obviously. I think also, someone like Peter Thiel is actually I guarantee you he is lawyering up in a major way right now.
Oh, for
sure.
Because
what he did,
Founders Fund.
I mean, what he did is. I mean, I did do a little bit of securities law when I was a lawyer.
Yeah, when you're a lawyer, you kind of did securities law. Yeah.
Okay. And I studied this in law school. I had a great course with one of the greatest, securities professors in the world, John Coffey. And, I learned all of the great securities fraud cases from the 80s and stuff,
Nice.
And I mean, the stuff that they did just sounds awfully familiar. Like from those cases, back in the day. So
this is what let me just throw this out there. Not a lawyer, not an attorney, only a interested observer. I think this boils down to one critical point. And I'm going to use the fire theater analogy, which I've heard used lots. The question I think is going to be, was the theater on fire and Peter Thiel yelled fire, or did he yell fire and the chaos created the fire? I think that's what it
right. And that's the issue. That's where the fight will be, right?
That's it, right?
Because if things, and this will be hard to prove, right? And hard to defend against, but if it can be shown that, but for what he said, the stock price, would not have collapsed, then he's in trouble, especially if he made money off it. If he traded on that,
if he traded on it.
Well, if he didn't trade on it, there's not really there's not
There's
really
nothing to
much
go
liability
after.
because it's just like
Yeah.
he just said something. I mean, it's just like Jim
Freedom of speech.
Cramer. Yeah, like
Yeah.
Jim Cramer can get on TV and he does all the time and yell at people and
Yeah.
yell stuff
Yeah.
and make the
He has great
market
calls,
move.
man.
And
That guy's great calls.
yeah, and he's not in any legal liability if he's not
Yeah.
trading on that. But if it comes out that some of these people, they
Profited.
they made it, they sold short and then they came out and tweeted and then the market collapsed
Or they
and they
levered up
and
put options or something. Oh my
whatever.
goodness.
If it just
Yeah.
if they can show that money that they made money as a result of the stuff that they said to the market, they're going to be in some serious deep
Yeah.
water.
We're going to find out, I think, over the next 90 days or so, because there are somebody in the SEC is doing a lot of deep forensics.
Oh my God. I mean, there's a whole, I guarantee you that there are probably about, 25 lawyers right now at the SEC just working on this right now.
Yeah. It's going to be a lot of fun. So at the end of the day, let's go back to the banking crisis. So again, we kind of disagree. Is there one? Isn't one? Totally get it. I will say that at least at the moment, and again, this moment can change, where I'm saying this at 8:08 a.m. on March 16th. That's Pacific time. I think we're through the worst of it. I think a lot of things they put in place. I do think there's more shotgun marriages. As I said earlier, First Republic to JP Morgan, maybe these other ones that have high concentration in unsecured funds go somewhere. But I don't see the FDIC taking anybody over. I think they would see that as a loss, taking that over. So I think they will force acquisitions over the next month or so. What do you think of that?
It doesn't sound unreasonable to me. I mean, and listen, the thing is, one of the reasons why I think we're not necessarily in a banking crisis is, as you said, I think they acted promptly to kind of stem
what could have been.
Yes, I think it could have easily turned into a banking crisis, right?
Yes, we agree.
And they acted quickly to do it. But banks fail all the time. They just don't. It just doesn't make it into the news. But I mean,
well, it's not usually the second and third largest failures.
This is true. This is true. No, absolutely. You're right that the size matters.
Size matters. So, yeah.
Size matters in banking crises. But banks fail all the time. And usually nobody even knows about it. Right. So the fact that banks failed that fact alone doesn't really tell us much. Yeah. But
at the end of the day, this channel is about finding opportunity in the chaos. I think one of the things that will come out of this is commercial lending will seize up. We talked a lot about that in video 1. I also think there will be assets that go back to the bank where sellers are become forced sellers, and there will be deals to be had. You're putting on an event at the end of April that I will be attending, and you have a discount code for ORAT that I think is ORAT30. So what is the website they can go check out and all of that?
So this is the Multifamily Wealth Project Conference. We have a bunch of ORAT fans coming to meet Michael and Olivia and me. And this is going to be a really, really great event. If you saw our video from last week, we have a really, really great lineup of really experienced syndicators, lenders, brokers, people who really understand the markets and really are thinking very deeply about what is going on right now, how they're going to respond, what the best way to, protect yourself on the one side and take advantage on the other side, what these things really are, what they're actually implementing right now. There will be hundreds of people there for you to network with, potentially if you're looking to do syndications or just want to break into multifamily or just learn more. I mean, this is the place where you can meet people who are like-minded, who want to have the same conversations that you're having, share their knowledge and really, get to know you and you them. So it's going to be a tremendous amount of fun. It's April 26th to 28th in Las Vegas at the Link Hotel. Again, go to multifamilywealthproject.com to see the details. If you're watching this video, unfortunately, it means that you missed out on the big 50% off discount because that ended Thursday night at midnight, but we still have a pretty generous discount for you. 30%. Use the ORAT 30. That's ORAAT 30 discount code to get 30% off everything. And really look forward to see all of the ORAT fans at this event. It's going to be a lot of fun. It's
going to be a lot of fun. So, folks, if you want to check out what the event about, go to Jonathan Twombly's playlist. Last week you will see a video where we go through the whole website and all of that. It's again, I've been clear. There's two things I want to get better at. One is bigger deals. Other one, just to close it out, would be sub 2 and residential. These are places I look to round out my skills, but I'm going to go, I'm spending real money to go learn from Jonathan and his team. Thanks, buddy.
Thank you.